Lisa, let's start this off with you. We're riding high right now. The market's looking really good. Very strong numbers after that job report showed just about everything we wanted on Friday. But you've got the CPI number and then earnings coming this Friday. Are you ready for all of this? How would you be placing your bets ahead of it?
Well, we're still cautious, and really the reason why, to your point, is we've got progress to continue to make on both those fronts. In terms of the inflation numbers, we have seen what is an encouraging trend to see some of those price pressures drop. But if you look at the absolute levels, they're still high. So in our mind, we still have both an x-axis and a y-axis issue on inflation, meaning not only how quickly do those levels come down over time, but also where are the absolute levels that they land at. And certainly, we've got some concerns on earnings front as well. While we've had the expectations come down, we really are all anxiously awaiting really what the guidance will be for 2023.
Greg, what do you think?
So they didn't give us everything we wanted in that report, Becky. Inflation dipped down. Yes, wage growth slowed, but the unemployment rate dipped down from 3.7% to 3.5%. And the Fed's been very explicit that it's likely that we need to see about a 4.5% unemployment rate to curb wage growth in such a way that it will then curb service inflation growth. And so while that gap exists, short of a major contraction in the economy, or short of a meaningful reduction in inflation, and I just don't think we've seen that yet, although, yes, the direction has been positive, the Fed's going to stay the course. And this is one of the areas where I differ from consensus in that Fed funds rate is indicating a 25 basis point hike in February, indicating a terminal rate of around 4.8% and indicating cuts in the back half. And I don't think any of that's going to actually happen. I'm looking at a terminal rate at about 6%. I'm looking at about 50 bips in February, again, followed by another 150. And I don't see us talking about interest rate cuts until back half 2024. And largely, just to second our colleague, it's because all of the heavy lifting is likely still in front of us rather than behind us.
So, Greg, what happens if on Friday you start getting earnings rolling in and these companies start beating what is at this point lowered expectations?
Dramatically lowered expectations, Becky. Remember, about 6 months ago, we were looking at about 8% for the fourth quarter. Now we're looking at about negative 4%. And so I'm not sure that beats on expectations that came down that quickly. Earnings expectations in the quarter came down 6.5%. And so, number one, I don't think that that is going to be indicative of any change in the macro. And two, we're looking at 2023 estimates that are likely too high as well. Not as insanely high as we were coming into 2022, but still too high. I'm not sure how we get from a negative 4% in the fourth quarter to low single digits in the first and second quarter and high single digits in the back half. So I think that we're still going to undergo some negative revisions through the first two quarters, even if this quarter comes out a little bit more positive than the draconian expectations we're looking at this point. And I think that that'll be a headwind.